One of the important decisions business owners have to make is whether to extend credit to their customers. Establishing good credit policies are critical to a business's success. In this video, you'll learn to distinguish different types of credit sales and how accountants record them. Sales on credit are made by large numbers of wholesalers and retailers of goods, and by many professional people and service businesses. There are advantages and disadvantages, though, to selling on credit. The assumption is that the volume of both sales and profits will increase if buyers are given a period of a month or more to pay for the goods or services they purchase. On credit will lead to increases in profit only if each customer completes the transaction by paying for the goods or services purchased. If payment is not received, the expected profits become actual losses and the purpose for granting the credit is defeated. Therefore, businesses need to closely analyze a customer's ability to pay before granting credit. Decisions about granting credit may be based on personal judgment or on reports available from credit bureaus, information supplied by other creditors, and credit ratings supplied by national firms such as Dun & Bradstreet. Dun & Bradstreet is a leader in providing credit information. The company's stock trades on the New York Stock Exchange. Its ticker symbol is DNB. For the year ended December 31, 2021, the company reported revenues of $2.2 billion. Each business must develop well-balanced credit policies. A credit policy that is too tight may result in both lower bad debt losses and reduced sales. A credit policy that is too lenient may result in both higher bad debt losses and increased sales. The four most common types of credit sales are open account credit, business credit cards, bank credit cards, and cards issued by credit card companies. Open account credit sales and business credit card sales are accounted for as sales on credit. Sales to customers using bank credit cards and cards issued by credit card companies require special accounting procedures. Sales made to customers paying with bank credit cards, such as MasterCard and Visa, are treated as cash sales. In most cases, the amount processed on the card is transferred to the seller's bank account the same day. Fees charged by the credit card company for processing these sales are debited to an account called credit card expense. Let's look at an example. Max Out Sporting Goods sells merchandise on January 15th totaling $900 to customers using bank credit cards plus 8% sales tax. The bank credit card company charges a 3% discount fee. To calculate the net amount of cash Max Out Sporting Goods will receive, we start with the sales amount for the merchandise, which is $900. We add the sales tax of $72, which then gives us the total of $972. From that amount we subtract the 3% bank fee of $29.16, which results in a net amount of cash received from the bank of $942.84. How do accountants record this sale? The following journal entry is how accountants record NBSP, sales made to customers using the bank credit cards. These bank credit card sales are treated like cash sales and we record the credit card expenses immediately. The asset account cash is increased by $942.84. The expense account credit card expense is increased by $29.16. The revenue account sales is increased by $900 and the liability account sales tax payable is increased by $72. Credit cards such as American Express and Diners Club are issued by business firms or subsidiaries of business firms that are operated for the special purpose of handling credit card transactions. The potential cardholder must submit an application and pay an annual fee to the credit card company. If the credit references are satisfactory, the credit card is issued. It is normally reissued at one-year intervals so long as the company's credit experience with the cardholder remains satisfactory. These types of credit cards are also called non-bank credit cards. For example, Max Out Sporting Goods sells merchandise on January 16th totaling $1,000 plus 8% sales tax to customers paying with American Express. Assume American Express charges a 4% discount fee. The discount withheld by American Express would be $43.20, which is $1,080 times 4%. The journal entries to record the sales on January 16 and the subsequent payment on January 23 by American Express are In the first journal entry, we'll record the sale on January 16th. We debit accounts receivable for $1,080 and credit sales for $1,000 and credit the sales tax liability account. Next, on January 23rd, when Max Out Sporting Goods receives the money from the credit card company, we'll debit credit card expenses for $43.20 and debit cash for $1,036.80 and credit accounts receivable. Let's summarize. Selling on credit has its advantages and disadvantages. There are 4 common types of credit sales. Open account credit sales and business credit card sales are accounted for as sales on credit. Credit card sales and non-bank credit card transactions are treated like cash sales.